Inflation in Nigeria is not only impacting the price of goods and services, it's also impacting savings and investments. Here's a notice from a bank in Nigeria that was emailed to customers about savings account rates, 1.4% per annum. Let's take a look at the latest bond retail offering from the federal government of Nigeria. These are retail bonds that are released, or rather offered once every month. Do we have the bond? This is the federal government savings bond. We should have that. Let's take a look at, there it is, yes. So 2-year bond, federal government savings bond, offering 9.4% per annum. The 3-year is offering 10.41%. Opening date on Monday, it closes on Friday, August the 5th. This is from the Debt Management Office. So a reminder, let's take a look at inflation again. And you heard Bismarck Rewane in that special report from Oyin Sunday talking about the difference in inflation and treasury bill rates, for instance. So headline inflation, 18.6%. You put all this together, let's take a look at the real rates of return for, there it is. So you've got a savings rate of 1.4%, 3-year August retail bond at 10.41%, inflation at 18.6%. If you subtract the real, that's what the triple R is, the real rate of return for savings, that's 1.4 minus 18.6. You get a negative 17.2%. On the retail bond side, a negative 8.19. So what to do? Kayode Omosebi joins us to discuss further. He's the CEO of Cedar and Ash Capital. Kayode, good morning to you. Thanks for joining us.
Good morning. Yeah.
So what does one do when you've got rates like that? How do you cope with where inflation is?
Well, it just says that you can't grow wealth by saving. You have to look away from savings, right? Savings naturally, especially in Nigeria, with inflation risk and the fact that the interest rate environment doesn't really reflect in the savings. It just means that people will save less and start to look for other investments. There are some more exciting ways to save. I mean, those are where mutual funds come into play. Even though some of them too will still align with the market rates, but at least it gives you some edge against inflation. Okay. So, I mean, I don't expect anybody to assume to save to edge yourself from inflation and risk because of what's happening in society now. Right. So you need to look at more investment instruments. Yeah.
Okay, so I guess if we're looking at a typical investment portfolio and how to put it together, you mentioned mutual funds. What other mix is there that one can use while in Nigeria?
Okay, well, the devil is in the details, which we can't really say now. But for people, I mean, there's a random mentality that your age minus 100 should be that allocation to some sorts of risky investments. If you look at Nigeria's macros, you need to look at like defensive stocks, increase your allocation to stock markets, because stock markets sort of, depending on the companies, provide you edge against inflation and interest rates, like investing in banks. There's also a need to sort of increase allocations to FX instruments, I mean dollar investments or dollar-linked investment. Dollar-linked investment will be investment in companies that are defensive to dollar. So if you're buying a seplat, for example, and that gives you an edge against currency. And then you can now look at other platforms. I mean, there are a lot of platforms today that gives you access to investing foreign investments like the Truth, the Rise, and Co., where you can invest in stocks, invest in real estate offshore. That's what I think investors will be looking at. And it's almost the play now. A lot of people are looking for dollar investments. People don't want to own Naira just because of what's happening in the space now.
Thank you. Okay, and in your economic outlook, you talked about risks and opportunities. As far as sectors, where are those opportunities for those sectors in Nigeria?
Well, from a macro standpoint, I mean, naturally, companies, I mean, sectors that gives you defensive against inflation and FX. Real estate, obviously, that's number one. Either you're buying real estate or investing in real estate products like REITs, right? That gives you an advantage.
Just for our viewers, REIT is real estate?
Real estate investment trust scheme, right? So you just buy units and get advantage of real estate. Then also, if you look at the banking sector, banks that are net dollar, and also have very liquid investment securities will benefit from an high interest rate environment. That's also one to look at. But it's just important to look at the risk asset, the loan portfolio of banks, because as we're going into a economic crisis, some sectors are going to suffer, and that will impact on the loan portfolio of banks. So NPLs might increase for a few banks. The FMCG space is also quite good. Defensive companies, you have those Nestle's and Co. who have very little reliance on imports and also foreign exchange exposure. And so those guys will also do fine. Agriculture is also one, because imported inflation sort of impacts on prices, local prices, and so you expect to see higher margins for some agricultural players. So that's also a good investment play to look at in terms of sectors.
Your Prescos and your Comos
and exactly,
like that. Your economic outlook, you mentioned that businesses should use this period to reprice the loans that they have with banks. Is that a challenge considering that most of the banks use fixed rates loans. Can you talk about fixed rate versus floating rate loans and how that can impact businesses that you're advising to reprice the loans that they have?
Yeah, so with floating rate loans, the risk is when interest rate goes up, you're likely to get that repricing. And I mean, that's already the norm. Few banks have indicated to some of their borrowers about between 2 to 4% increase in their loan rate. So what I advise companies to do, which you require a financial advisor, is to restructure your loans. So if you have loans maturing maybe by end of the year, it's the best time to sort of refinance them. You can also find a way to fix your interest rate by moving away from plain vanilla loans. If you do like lease financing, if you're trying to buy assets, it sort of locks in the rates as against getting that floating rate. So best time to, if you have also short-term loan, is the best time to refinance, get longer tenors, because between now and maybe 2 to 3 years from now, we're going to have a high interest rate environment, high inflation. Because truth is, if we even change, if we have a new government and they go pro-market initially will sort of drive higher prices, and you still have inflation and interest rate environment. So it just makes sense that once you look at the outlook, just try and lock in on interest rate. And you can see that with also non-traditional loans. Yeah. So people who issue bonds. Bonds are fixed rate. Most bonds are fixed rate in Nigeria. So you can also issue bonds. And that's why you've seen most of the big corporates, going to the bond market, going to the CP market, sort of locking on rates at this point.
And just CP is commercial paper.
Commercial paper, sorry.
Okay, good stuff. Yeah. See, I like that. I actually like that outlook that you have where if you expect that a new administration coming in would go pro-market, then rates would rise. So you want to lock in ahead of that. That's if that happens. Yeah. But if the opposite happens? I mean, it's still up in the air. Yeah, but the truth is, I mean, if you take away political concerns, a lot of policies should have been implemented now. Yeah. So when you take over the election, sometimes it's not about what they want to do, but the situation on ground just calls for what must be done. Yeah, so ex-political concerns around elections and co. There's really no need to hold on to subsidy. Right? There's really no need to sort of peg the currency. Right. If you remove subsidy, immediate impact will be high fuel price, and that's inflation already. If you also try to liberalize like the power sector, where you sort of like take away the TCN, then you're going to have high energy prices, right? Immediately, even though later on it might fade down. So there's no gaining about it that we're going to face high inflation, for the next 2 years. Because they're trying to manage it now, but the new administration who will come in can't support this subsidy bill. It's a lot. IMF is saying that we're going to spend up to 6 trillion naira this year on subsidy. And that's one of the issues with NNPC and CBN, because the subsidy bill is impacting on remittance to the FAC. So whoever is going to come into power would have to take some very, very hard decisions for the economy to thrive. Are banks the biggest winners in this current interest rates environment?
Well, somehow, but then there are still other guys who might be better. So oil exploration companies sort of are more better because of the FX edge against currency, crude oil price and co. Banks, yes, will be a good beneficiary, but it's not the entire sector. You need to look at it well. Not all banks have more dollar assets than dollar liability. So if you have dollar liabilities, which is higher than dollar assets, you're going to face FX losses, right? If you also don't have enough liquidity, then you don't benefit from the high interest rate environment. So why the banking sector would do fine, it's quite important to look at the pockets of banks and look at the ones that are doing fine, have good capital adequacy ratio to back any concern on their loan portfolios. So I would say tier 1 banks, few names, GTBs and co's, will do fine. Then it's also important to look at the small banks more emerging and growing, because those ones also have that high growth in terms of profitability that would do fine. So that's like the tier 1. So Sterling Bank seems to have that long-term view that seems to be quite attractive.
In-depth stuff, Kayode. As far as the exchange rate, let's get to that. You saw that special report from Oyin Sunday on our team. Are there, I guess, opportunities and risks? Well, everybody's been talking about the risks because of where the price is. But then opportunities within those risks as far as the FX situation is concerned. Yeah,
from an investor standpoint, the opportunities for either those who already have dollar investments or do not have. Export businesses related are thriving at this point in time. FX market banks are making more money from FX trading, at this point because of the spreads. Yeah. So you will see pocket opportunities for few guys. Sectors who have more imported demand, where local capacity cannot meet the demand and they have to import. You'll see higher margins because price will go up. And so those are the kind of opportunities you have. But on a national scale, it's more of the risk than the opportunity because it sort of affects everybody from food prices to inflation to interest rates. And so that's why if you look at it from net gain in terms of CBN or government decision, there needs to actually look at the FX market and sort of either free the currency or move the official rate to good levels. So.
Do you see, I mean, you already touched on fuel subsidy a moment ago. Okay, and I guess your position is already that it has to happen, but will it with this next, whoever comes into office in 2023? You can't, I mean, you're not in that position to tell, but I guess, are you optimistic that it will happen?
Yeah, I think so. Just if I look at the three significant candidates for 2023, the three top guys, I'm looking at what they say and looking at their precedents. They seem to be more aligned to pro-market. They seem to want to attract private sector investments. And if you have to go that route, then you would have to sort of remove subsidy because those are like key things that can fix the country. And we talk about refineries not operational, not doing fine. You can't expect a refinery to be profitable with a subsidy market. Once you free it, it drives investment, it drives more efficiency. So I think that it's a no-brainer that they would have to let it go.
Are we putting too much, do you think we're putting too much hope in the Dangote refinery to, I guess, reduce the import bill on refined fuels coming into the country, increasing supply and so on and so forth? What do you make of what to expect with the refinery? Well,
we're not too much hope, but the thing is, it can't be effective or profitable or beneficial to the country if you still have the subsidy bill. I mean, an IOC cannot sell crude oil to Dangote in Naira, right? And Dangote is not going to sell petrol after refining at 165, except the government is going to be paying that subsidy to him. So at the end of the day, the effectiveness or how it's going to impact on the country needs to allow market efficiency, where the market players can determine pricing, and that alone attracts investments and other things. So Dangote refinery will help, but you need the government policies that will back that efficiency and profitability for the country.
Great stuff. Still on subsidies, whether they stay or go in 2023, the existing refineries that we have on ground, are you of the opinion that they should be sold, that they can be rehabilitated? I know that there's billions that are already being spent on rehabilitating them and so on and so forth. What do you think should be done with those existing refineries that are already on ground here?
Yeah, so I think they need to transfer operatorship, right? Okay. When you look at those refineries and the kind of liabilities, costs they've taken, it's almost impossible for anybody to want to pay for these assets now because you need to drive more investments into it. So the best way is either to give a concession, right, and also back the investments that is required for you to play. So as against trying to sell someone, that is one of the problems we also have in power sector, where you sell assets overvalued, people put money there, and there's no money to sort of invest in making it more efficient. So those refineries also need to be concession to private players who can sort of run it, and then we'll see how the growth will take it away from the government, because it doesn't make sense where last year 2020 refineries don't operate and you have almost about between 20 to 100 billion in operating expenses. So you need to just take that and give the private sector so that it doesn't become a big problem to NNPC. NNPC gets sort of stay profitable on the upstream side, sometimes on the downstream side, but within that refinery space, there's a massive loss, and that impacts on the NNPC's financial numbers going forward. So the refinery needs to be out of the government's control, and over time, then you start to see that impact on the country and also the sector itself. How
do you feel about NNPC becoming a limited liability company now? And
well, it bodes well, but the devil is in the details, because what has happened is it's not entirely NNPC changing to a company. There are certain scope that differentiates NNPC Limited from NNPC as a regulator. So it's those details that sort of determines on how profitable NNPC will be, because the NNPC as a regulator will still continue to operate. And it still has other subsidiaries like the PPRA, who sort of controls the downstream sector. You have the DPR and co. So we need a true overall of the industry, which is where the PIB comes to play. And once that is done, then it sort of impacts end to end. You can't start to fix the hand without fixing the legs and the head, because everything will still impact on the value chain across the sector.
Kayode Omosebi, CEO, Cedar and Ash Capital, thank you so much for joining us to talk about the economic matters facing the country. Appreciate your time.
Thank you.